So, you're thinking about moving to Ireland. Awesome. Your mind probably jumps to the stunning green landscapes and, let's be honest, the taxes. There's this common myth that the Irish tax system is this impossibly complex and expensive beast. But what if I told you there's a powerful, kind of hidden advantage built right into it? An advantage designed specifically for people moving there from another country. Check this out. This one sentence is the key that unlocks everything. It says that your income and gains from outside Ireland can accrue entirely free of Irish tax. Just let that sink in for a second. It means your foreign investments, your savings, they could potentially grow completely untouched by the Irish tax authorities. Sounds way too good to be true, right? Well, that's the million-dollar question, isn't it? How on earth is this possible? And that's exactly what we're going to break down. It all boils down to a few key ideas that aren't super obvious at first glance, but once you get them, they are absolutely crucial for anyone planning a move. Here's our game plan. First, we'll look at what I'm calling Ireland's tax welcome mat. Then, we'll get into the single most important concept, the difference between residence and domicile. That's the real key. From there, you'll see how it unlocks the remittance advantage. We'll do a quick look at other reliefs and taxes, and finally, we'll wrap it all up so you can make your own smart move. All right, let's dive in with the basics. You see, how much tax you pay in Ireland isn't just about whether you live there or not. It's actually decided by 3 different, very specific statuses. Understanding these is really the first step to making the whole system work for you. So here are the big 3. Residence, which is basically about how many days you spend in the country. Then there's ordinary residence, which is based on a 3-year pattern. And finally, domicile. Now, the first 2 are pretty straightforward, but it's that last one, domicile. That is the real game changer for anyone moving to Ireland. And that brings us to the absolute heart of this whole explainer. This right here is the secret key. It's this critical difference between the country you happen to be living in, that's your residence, and the country that's considered your permanent financial home, your domicile. So what in the world is domicile? Well, the easiest way to think about it is your forever home. It's the country you see as your permanent base, the one you plan to return to someday. For most people moving to Ireland from, say, the US or Canada or Australia, their domicile stays right there in their home country. And that one little fact, well, it changes everything. And here it is. This is the big aha moment. If you were both a resident and domiciled in Ireland, you'd get taxed on your worldwide income. Everything. But, and you've got to love this, if you are a resident but you are not domiciled there, you only get taxed on your Irish income, plus any foreign money you actually bring into the country. The difference between those 2 scenarios is just massive. So what this means is that being non-domiciled is this incredibly powerful status you can have when you move to Ireland. It completely changes the rules of the game for your foreign income and basically opens up a clear pathway to some really significant tax savings. Okay, so how does this actually play out in real life? That non-domiciled status unlocks the system's biggest perk, something called the remittance basis of taxation. This is where all that theory turns into actual real-world savings. This is how you unlock the treasure chest. So here's what it means for you. You know that investment portfolio you have back home? Or maybe income from an overseas rental property? As a non-domiciled resident of Ireland, all of that can grow and build up, completely free of Irish tax, as long as you don't actually bring those funds into Ireland. Which, of course, leads to the next big question, right? If bringing money into Ireland triggers the tax, how are you supposed to, live? How do you pay your bills? Well, the key is some smart planning to avoid a really common trap. And believe it or not, the solution is surprisingly straightforward. The strategy is all about how you structure your finances, ideally before you even make the move. You set up 2 separate bank accounts outside of Ireland. One is for your capital, and the other is for your income. You then only ever transfer money into Ireland from that capital account because bringing your own capital into the country isn't a taxable event. So what is this capital we're talking about? Think of it as your pre-existing wealth. It's all the money you earned and saved before you became an Irish resident. It's also things like gifts or inheritances you've received, or money you got from selling assets before you moved. This whole pot of money is your capital, and it can be brought into Ireland tax-free to fund your life there. Okay, so this whole non-domicile advantage is obviously huge, but it's not the only piece of the Irish tax puzzle. To give you the complete picture, let's do a quick tour of a few other key reliefs and taxes that you'll want to have on your radar. First up, there's a really big one for employees who qualify, and it's called SARP. It's a special program designed to attract highly skilled senior people to Ireland. And the great thing is, it's available to you whether you're domiciled there or not. So the main ticket to get into the SARP program is a base salary over 75,000 euros. If you meet that and a few other conditions, the benefit is just incredible. You can exclude 30% of your income between 75,000 euros and 1 million euros from income tax. I mean, for high earners, that can translate to tens of thousands of euros in tax savings every single year. Now, beyond SARP, there are 3 other taxes to know about. There's capital gains tax, or CGT, at 33%. But again, for non-domiciled folks, this often only applies to Irish assets. Then you have capital acquisitions tax, or CAT, on gifts and inheritances. It's also 33%, but non-doms get a 5-year pass on non-Irish assets. And finally, there's something everyone pays called the Universal Social Charge, or USC. The UST is basically another tax that's calculated on your gross income, on top of regular income tax. The rates are tiered, like you can see in this example from a few years ago. They start off really low and then climb up to 8% for the highest earners. Now, these specific numbers change from year to year, but the idea is the same. It's a really important part of your overall tax picture in Ireland. So, let's pull all these threads together. We've gone over the core concepts, we've pinpointed that one key distinction, and we've seen how it all works in the real world. Now it's about putting these keys to good use. Look, if you only take one single thing away from this entire explainer, please let it be this. Your domicile status is the master key. Understanding it, confirming it, and planning around it is the single most important thing you can do for your financial health as an expat in Ireland. And that brings us right back to that powerful quote from the very beginning. Suddenly, it makes perfect sense, doesn't it? When you understand your non-domiciled status and you manage your funds correctly, the charge to tax can be limited, opening up a whole world of financial efficiency. So, it turns out the Irish tax system isn't just some scary monster you have to fight. It's actually a system with a clear set of rules that, if you know them, you can use to your advantage. We've just handed you the keys. The only question left is, how are you going to use them?